Hi guys, welcome to today's video. While the geopolitical tensions have come from abroad to our doors now, a lot of investors today are anxious about the impact of this local event and its implications on the stock market, as there can be a lot of ways to look at it. Let's discuss some of those to make sense of the current situation.
Number one, as you can see in this chart, stock market corrections are very natural, and they have been occurring almost every year. While this chart illustrates it very well, but we still know that in the same period, long-term returns of Nifty 50 TRI has been hovering around 12% approximately. So in short term, investors may overreact, but in the long run, market prices get aligned to companies' actual growth. Just like at the onset of COVID, markets fell sharply, but as quarterly earnings were still positive and economic prospects were good, money again started pouring in, and we are all witness to last 5-year returns, even after the drawdown that we've seen since September 2024.
Number two, since the onset of tensions, Pakistan's stock markets have corrected by good percent, while Indian markets are holding strong. This has to be attributed to our strong and resilient economy, which is also getting supported by foreign flows. Our trade deficit, fiscal deficit, active policy actions by both central bank and government, decent import cover of above 11 months, low debt across households, corporates, and government are some of the factors. And all of this is keeping in mind that the growth forecasts are not compromised yet. Which brings us to point number 3. What Moody's report is saying about the impact of war on markets.
Number 4. Let's look at what happened to markets during similar events in the past. As you can see here, drawdowns were not very large during past such events. But that obviously doesn't define the future. While nature of event is similar, the extent can be different every time, and that is what we all need to watch out for. For example, during Kargil War between May to July of 1999, Nifty gained approximately 33% over the 3-month period. But in Parliament attack of December 2001, markets declined nearly 14% between December 13, 2001 and October 1, 2002.
Number 5 is investor behavior and media sensationalism. Fear sells headlines. Geopolitical tensions often receive heavy media coverage, which tends to amplify public fear. This fear can lead to short-term selling pressure. Behavioral finance shows that retail investors are more likely to panic sell, while institutional investors often view such events as buying opportunities, such as during Balakot airstrike of February 2019. Nifty experienced a brief dip but recovered within weeks.
Number 6 is sectoral impact. Not all sectors react the same during wartime scenarios. Defense, energy, and commodities, like oil, may see increased interest. Travel, hospitality, and consumer discretionary could take a short-term hit. Investors rotate capital into safer or defensive sectors like FMCG, pharma, and utilities during uncertain times. So your diversified or hybrid mutual funds, diversified stock portfolios might be able to weather the situation better.
Point number 7 is timing and duration of conflict. Markets tend to react negatively to uncertainty, not necessarily the conflict itself. If war is short-lived or contained, markets usually rebound quickly as clarity returns. Point number 8, oil prices and rupee impact. One of the biggest external risks for India during a regional conflict is spike in crude oil prices and its impact on CAD current account deficit and NR depreciation. However, India's diversified energy import sources and rising renewable mix act as partial shock absorbers today, unlike in 1990s or early 2000s. Point number 9, global correlation and risk premium. Global investors may reprice risk for the region, which can impact risk premiums for Indian equities, even if war is short or limited. However, in recent years, India's beta volatility to global markets has decreased, showcasing resilience. Look at the case of inclusion of bonds in global indices and our forex reserves. And final point is that volatility doesn't necessarily equate to economic recession. War or skirmish does not automatically mean GDP contraction. Business activity may slow temporarily, but unless it's prolonged, the economy typically stays on track. So let's watch out how the situation pans out.
Before we conclude, it's important to stand in solidarity with the families of the victims of the Pahalgam attack and all those affected by this tragic incident. While markets and economics are important, human lives are far more valuable, and no analysis should overlook that. As investors and citizens, we must remain calm, stay informed, and closely observe how the situation evolves, both on the ground and in financial markets. Responsible investing also means being aware of the broader picture and acting with empathy and patience.